Welcome back to the Deep Dive. Today, we're putting on our high-vis vests and hitting the rails. We're taking a sharp look at Union Pacific Corporation, that's ticker UNP, following their third quarter 2025 results release.
Yeah, the documents came out October 23rd.
And they really tell a fascinating story, don't they? It's this massive balancing act. So our mission today is to distill how one of the country's biggest railroads managed these impressive, actually record-setting efficiency gains. And rising profit, too, even though the total amount of stuff they moved, the volume, was basically flat.
Right.
And critically, we have to look at all this performance through the lens of their biggest strategic goal right now, that proposed really historic acquisition of Norfolk Southern.
That's exactly the frame we need. I mean, this quarter wasn't driven by some huge market boom or, a big consumer recovery. Not at all. It was purely about internal execution. We're looking at a company that is squeezing every last bit of margin out of its existing network. The sources, the earnings call, the slides, they tell us what drove that record performance, and maybe more importantly, what their priorities look like now that they've, hit the brakes on share buybacks to focus completely on getting this merger done.
Okay, let's start there then. Section 1. The financials, the cost of efficiency, maybe.
Yeah.
The headline numbers definitely show that strategic focus on efficiency and pricing power really paid off on the bottom line. Reported net income was $1.8 billion. That's up 7%. Diluted EPS jumped 9%.
Solid numbers, yeah.
But the number that, really matters if you're looking at future growth, that's the adjusted EPS. It was $3.08, up 12% year over year. And that adjustment is crucial, right?
It is. Because it pulls out those growing costs, the legal and administrative stuff tied to that huge merger plan. Those acquisition-related expenses, they hit $41 million in Q3 alone. That's about, 7 cents per share.
Wow. Okay, so the regulatory years are already grinding and costing money.
Definitely. But look at the top line, operating revenue. It grew 3% to $6.2 billion. And here's the really key insight from the documents. That 3% growth, it was almost entirely driven by pricing.
Okay.
Yeah. Core pricing and mix changes gave them a strong positive bump, plus 3.5%. And they absolutely needed that pricing power because, like you said, physical volume was actually down slightly, minus 0.25%. Plus, they had a negative hit from lower fuel surcharges, too.
So, bottom line, they made more money by charging more for the freight they did move and moving it more cheaply.
That's the essence of it, which brings us right to the operating ratio.
The key metric for any railroad, right? Operating expenses divided by revenue, lower is always better.
Always. And they hit an adjusted OR of 58.5%. That's a really impressive 180 basis point improvement year over year.
Extremely lean operationally.
Incredibly lean.
But, okay, since volume was flat, actually slightly negative, does that just reinforce the argument that maybe they're hitting the ceiling on efficiency gains alone? I mean, how much lower can they push this OR before they just need genuine economic recovery at a higher volume? Or that massive network expansion the merger promises?
That's the central tension, absolutely. And you can tell management is aware of it. On the expense side, they mention, ongoing inflation, higher incentive pay, and those merger costs we just talked about.
Right.
But they managed to offset almost all of that. The total increase in operating expenses was just 1%, which means that productivity gains were basically canceling out inflation and the cost of planning the merger.
That's pretty remarkable execution.
It really is. It's the definition of operational execution.
Okay, section 2. Let's zoom out from the spreadsheet and look at the actual tracks, the physical side. How did they turn a flat freight market into margin growth like that? It must take real ground-level change. Here's where it gets really interesting.
It absolutely does. And these operational records, they set like shorter dwell times, longer trains. These aren't just random good luck. They are the textbook results of years spent implementing that operating model known as precision scheduled railroading, or PSR.
PSR, right. We hear that acronym a lot with railroads.
And the insight here is just how far they've pushed that model. It's all about running fewer trains, but making them more consistent, more reliable, with fewer stops.
Okay, so give us some numbers. How did that play out?
Well, take efficiency. They hit a new all-time record for terminal dwell time. That's how long a freight car sits waiting in a yard. They slashed that by 9% down to just 20.4 hours. That's huge.
9% is a big drop. So cars aren't just sitting around as much.
Exactly. Think of it like your package spending less time sitting on a loading dock and more time actually on the truck heading to you. That's network fluidity.
And I guess if cars move faster through the yard, they move faster overall?
Precisely. Freight car velocity, which measures that, improved 8% year over year. They hit 226 daily miles per car. And that was driven by that record dwell time improvement and generally better train speed, too. Things are moving quicker, more predictably.
Okay, and you mentioned longer trains. We also saw records related to scale, right? When you talk about running fewer longer trains under PSR, what kind of scale are we actually talking about?
We're talking massive scale. The average train length hit 9,801 feet. That's up 2% and another new operating record for them.
9,800 feet. It's hard to picture.
Okay, picture this. That's nearly 2 miles of cargo. Almost 2 miles long. Essentially a slow-moving, incredibly efficient skyscraper on wheels.
Wow. Okay. 2 miles.
And longer trains mean you need significantly fewer crews to move the same amount of freight. That ties directly into the 6% jump they reported in workforce productivity.
Right. Fewer people moving more stuff, basically.
More output per employee than ever before. And it wasn't just people, it was the machines, too. Locomotive productivity improved 4%. They're hitting 140 gross ton miles per horsepower day. Now, that's a pretty technical metric.
Yeah, a bit technical. What does it mean in simple terms?
It essentially tells us they're getting more pulling power, more work, more overall efficiency out of every single engine they have on the network. It just confirms that the PSR strategy is really reaching deep into optimizing their physical assets.
It's also worth noting, they pointed out that even while pushing these operational limits faster, longer, leaner, their safety performance actually improved compared to last year.
Yeah, both personal injury rates and derailment rates were better year over year. That's crucial when you're running things this tight.
Definitely. Safety has to come first. Okay, section 3. We know the trains are almost 2 miles long and faster than ever. But what exactly were they hauling? Total freight revenue was up 3%, like you said, but that average hides a lot of variation between commodities. Let's break down who was pulling the weight and which markets looked a bit soft.
Right, there were two clear areas of strength. Bulk commodities in the industrial segment. Bulk revenue was up a strong 7% overall, and this was heavily boosted by coal and renewables.
Really? In 2025?
Yeah, revenue there soared 16%, and volume was up 13% year over year. They credited this lift mainly to natural gas prices. Higher gas prices made coal more competitive for power generation in certain regions. And they also mentioned a specific new contract win with LCRA.
LCRA, that's the Lower Colorado River Authority.
That's the one. So that boosted demand for rail-delivered coal, specifically in that area. Fertilizer revenue was also up 9% in bulk.
Okay, so a bit of a cyclical lift from, let's say, traditional energy sources. How did the maybe slightly more future-focused industrial segment do?
Industrial was pretty resilient, revenue up 3% overall. The real star performer there was industrial chemicals and plastics. Revenue and volume for that category were both up 8%.
8% for both. That's strong. What drove that?
They pointed to new business wins and also ongoing plant expansions. So it suggests that domestic manufacturing capacity, at least in those targeted chemical and plastic sectors, is still growing.
Okay, so bulk and industrial looking pretty solid. Where did they take the hit then? Where should we look for maybe some macro warning signs?
It was clearly in the premium segment. That's where you find your consumer goods, your finished vehicles, your international trade stuff moved in containers.
Intermodal and automotive.
Exactly. Intermodal volume was down 5% and the revenue was down 3%.
And that premium weakness, especially intermodal, that usually points towards softer international trade, right?
Yeah.
Things coming through the West Coast ports. Maybe sluggish demand for consumer goods.
That's generally the read-through, yeah.
Is this a big macro warning sign, do you think? Or is it maybe specific to UMP's network or market share battles?
Well, it's probably a bit of both, but they themselves framed it as primarily macro. They specifically signal that they anticipate lower international imports heading into the fourth quarter. So that confirms a broader softness, it seems, in global shipping and probably consumer demand for imported goods.
Okay.
And even domestic auto production wasn't totally immune. Automotive volume fell 1%. They tied that to some reduced auto parts production and also some specific quality holds at the OEM level, the car manufacturers.
So the message here seems pretty clear.
Mm.
Internally, operationally, they're performing, almost flawlessly. But the underlying demand for freight, especially those high-value consumer goods, it remains pretty challenging.
That sums it up well. Efficiency is great, but you still need stuff to move.
Okay, section 4. That brings us nicely to the forward view. If earnings growth is really hinged mostly on pricing and just maxing out efficiency, not genuine volume recovery, how are they guiding their 2025 outlook?
Hmm.
And maybe more importantly, how does this huge Norfolk Southern merger plan completely reorient their whole strategy?
Well, management sounded pretty confident. They reaffirmed their 2025 outlook, sticking to their goal of achieving high single to low double-digit earnings per share growth over the 3-year period. And they expect the pricing dollars they get to continue being accretive to the operating ratio, meaning it should help keep that OR low or push it even lower.
So they're betting they can keep this efficiency train running, so to speak.
Pretty much, yeah. And financially, they emphasize they're rock solid.
Yeah.
Generated $7.1 billion in cash from operations just year to date. Maintained strong A credit ratings across the board.
Okay.
They definitely have the financial strength for what comes next. And they're going to need it because they are making a truly historic bet.
Let's focus right there on a crucial signal in their capital allocation strategy. They set the capital plan for the year at $3.4 billion. That's pretty standard. They increased the dividend by 3% in Q3, which is nice for shareholders. But the most important decision, the big flashing sign, was hitting the brakes on share repurchases.
Absolutely. Pausing the buybacks, that isn't just some minor capital shift. It tells you everything. It signals the company is basically hoarding cash now for the massive regulatory and likely legal battles ahead over this merger. Management noted it explicitly on the call. Share repurchases are paused specifically because of the pending acquisition of Norfolk Southern.
And the CEO, he called this a historic opportunity. I think the quote was, to create America's first transcontinental railroad.
That's the prize they're aiming for.
But that kind of expansion, merging two of the biggest players, it faces enormous regulatory hurdles, right? Antitrust concerns must be huge. The Surface Transportation Board is going to scrutinize every single mile of track, every potential competitive impact.
Oh, precisely. It's going to be an intense process. They are essentially swapping immediate capital return to shareholders, billions in buybacks they could be doing, for the chance at massive long-term network growth. This quarter, Q3, it proves they can run the current system flawlessly. They can extract every dollar of margin possible through PSR. The merger represents the next phase, the next potential leap in growth, moving beyond just optimizing what they have to acquiring the ability to cross the entire continent without handing off freight to a partner.
Right.
They are signaling very clearly to the market that achieving that kind of network reach, that transcontinental footprint, is worth sacrificing potentially billions in immediate buybacks.
Okay, so let's wrap up this deep dive.
Mm-hmm.
To summarize, Union Pacific, they delivered strong financial results in Q3, even with challenging, basically flat freight volumes. And they did it largely due to this intense focus on operational execution, setting records for speed, for dwell times, driven by their PSR model.
Exactly. That drove margin improvement, which compensated for the softness, particularly in those premium segments like intermodal. And the path forward now seems pretty clear. It's twofold. First, sustain this really elite operational momentum they've built. And second, focus every ounce of strategic energy and probably a lot of cash on achieving regulatory approval for that massive Norfolk Southern merger.
Yeah, it really feels like a defining moment for the company. They're trading the maximization of their existing assets, which they've gotten incredibly good at, for the potential expansion of their entire network map. A huge strategic pivot.
It is make or break time, potentially.
Which leaves us with the final provocative thought for you, our listener, to explore. Given that these strong earnings were driven primarily by pushing the efficiency ceiling and really leveraging pricing power rather than actual volume growth, how much long-term value will the proposed Norfolk Southern merger and that massive expansion of network reach it represents, how much value will that actually add to the Union Pacific business model? Especially assuming global freight volume does eventually see a robust recovery.
Yeah. Will the merger provide the necessary volume foundation, the growth engine that maybe pure efficiency gains alone can no longer fully support down the road?
Something to think about. That's all for this deep dive. We'll talk to you next time.